October 30th, 2024. One of the world's most powerful accounting firms, Ernst & Young, did the unthinkable. They quit.
Supermicrocomputer plunging after Ernst & Young resigned as a company's auditor.
And it's not a demand issue. It's like a fact that you're back and you failed somewhere on the management side of this.
Right. But they didn't just quit so quietly. They put out a public warning that they could no longer trust the management of the hottest AI stock on the planet at that time, Supermicrocomputer Inc., or SMCI. When the people whose job it is to verify the numbers say they don't believe the numbers, that's about as serious as it sounds. The stock fell 32.6% that day. SMCI had just been added to the S&P 500, fueled by a $30 billion wave of forced investment. But while the public saw a rocket ship, some people that peeked behind the curtain saw a house of cards. This isn't a story about a bad company. It's a story about what happens when a number owns you instead of the other way around. I will explain it to you. What do I mean by that? But first, you had to remember that the smarter you think you are, the worse your attempt trying to deny it. Why did so many people watch $50 billion in wealth vanish without hitting the sell button? I don't think it's because they didn't see the red flags. It was because they were focusing at the wrong variables, aka numbers. They saw record sales and a booming AI industry, so they used it to justify holding on. They were anchored to the idea that SMCI was a winner even as the foundation was rotting. In psychology, it's called anchoring, and it's how your own intelligence can be used against you. It's not a character flaw, and it's not a sign that you're bad at this. It's just how your brain works. When you first encounter a number, your brain latches onto it as a reference point, basically treating it like the real value of something, even when the actual situation has completely changed. All right, think of it like a price tag that got stuck to the product. Even after the sale ends, even after the product gets damaged, part of your brain keeps checking back to that original price. That's basically what anchoring does to investors. With SMCI, the anchor was around $1,000 a share. If you bought in at $200, you felt like a genius watching it climb. If you bought in at $800, you told yourself you were getting a deal because, hey, it was just at $1,000, right? The anchor made $800 feel cheap. It made $700 feel like a bargain. It made every dip feel like an opportunity rather than a warning. But there's a trap inside the trap, and this is where it gets sneaky. You see, spotting a great company and spotting a great stock are two completely different skills, and most people treat them like the same thing. SMCI's AI server business was genuinely real. Demand was exploding, revenue was growing, and the company wasn't fake. But the stock was already trading at about 40 times earnings, roughly 4 times its own historical valuation. You weren't buying a great business at a fair price. You were buying a great business at a price that assumed everything would go perfectly forever. Then the S&P 500 inclusion hits in March 2024, and it feels like the whole world is confirming your thesis. $30 billion in rebalance trading pushes the price up. CNBC is talking about it. Your Discord chat is talking about it. Every signal around you is screaming, "You were right." And then, in August 2024, Rosenblatt Securities is still holding a $1,300 price target on the stock, a Wall Street firm with analysts whose job is to know better. That kind of external validation makes it almost impossible to question your own anchor. If the pros agree with you, how could you be wrong? This is the psychological trap at the center of all of it. The smarter you are, the better you get at building a case for why your anchor is correct. You find the data points that support the thesis, you explain away the ones that don't. Confirmation bias doesn't just show up alongside anchoring, it acts as its bodyguard, protecting the number in your head from any evidence that might threaten it. So the illusion felt airtight, but something was already quietly breaking underneath. Ernst & Young didn't just randomly decide to quit on October 30th. There was one specific number in the books, something most retail investors never even look at, that told them the ship was already sinking. So let's take a look at the evidence. The first crack showed up on February 16th, 2024. SMCI dropped 19.9% in a single day from its peak above $1,000. Most people called it profit-taking. Anchored investors saw it as a chance to buy more. After all, the number in their head said this stock was worth more than where it was trading, so the dip felt like a gift. But then, April 19th, 2024, the stock down to 23.1% in one day. SMCI broke its streak of pre-announcing positive earnings, which is a specific signal the market pays close attention to. When a company stops getting ahead of its own good news, it usually means the good news has gotten harder to find. The market read that correctly, but the anchored investors read it as another buying opportunity. What was actually happening underneath both of those drops was a gross margin compression story that didn't get enough attention. Large AI customers with the biggest buyers of SMCI's servers were negotiating heavy discounts. Pricing power was shrinking. And this mattered a lot because the 40 times earnings multiple the stock was trading at had been built on two engines: sales growth and margin expansion. By early 2024, one of those engines had stopped. The valuation suddenly looked fragile in a way it hadn't before, but if you were anchored to a price, you weren't doing that math. Then August 28th, 2024, Hindenburg Research, one of the most well-known short-selling firms in the world, dropped a report alleging accounting manipulation at SMCI. Same day, SMCI announced it would delay filing its annual 10K report. The stock fell 19% in a single session. And even then, some analysts held their buy ratings. October 30th was the end of the line. EY's resignation letter didn't leave room for interpretation. They couldn't rely on management's representations anymore. They were unwilling to stand behind the financial statements, and that was not a standard auditor language. Accounting analysts called it extremely rare and a massive red flag. There's actually research that shows this kind of anchoring to a narrative doesn't just happen to retail investors. A study on IPO spinning found that when corporate executives received hot IPO allocations as side payments from investment banks, they stopped making decisions that were best for their shareholders and started protecting the relationship that was making them money personally. They got anchored to a narrative built by the people around them, and it changed how they acted, even when it cost the people they were supposed to be protecting. Same psychology, different scale. From SMCI's March 2024 peak to the lows in early 2026, the stock lost over 80% of its value. Investors who held through the whole story didn't just miss gains, they watched years of wealth disappear. So, how do you actually catch yourself doing this before it costs you? There's specific consideration for you that changes everything. Before you even hold or add to any position, it's quite simple, and yet most people really ignored and underestimate it. But I will show you exactly what it is in a minute. Look, spotting SMCI early was genuinely impressive. When you do the research, understanding the AI server thesis and seeing the demand before most people did, that was genuinely a real skill. But that wasn't the mistake. The mistake was treating your anchor as a destination instead of a data point. Think of it like using a GPS. The price you bought at is just where you started, not where you're supposed to end up. If the road is washed out, the GPS should reroute. It shouldn't keep insisting you drive into the flood because that was the original plan. SMCI at $1,000 was a starting point. When the road should have changed, the anchor didn't. That's where it cost you a lot of money. The stock was never worth $1,000 because it once traded there. A number on a chart doesn't owe you anything. Look, I'm not telling you to act like a robot and just ignored your own psychology. I'm just saying, give your future self a break. So, next time you buy a stock, just jot down 2 sentences on your phone about why. Not the price, just the reason. Why? And then, when the market starts screaming, go back and read it one more time. If the reason is gone, but you're still holding it, that's not a strategy, that's just an anchor. And anchors are meant to keep you in one place while the tide goes out. The goal here isn't to be right about every stock. Nobody does that. The goal is to be prepared. Be open to question your own anchor before the market does it for you, because the market is not so gentle about it. Please consider subscribe and like this video if you find it valuable so the algorithm can do you the favor. Thank you.